In the third quarter of 2007, the S&P 500 index reached a new all-time high, a peak of 1,576. The financial media declared a new era of prosperity. Yet on that same day, for every one stock that reached a new 52-week high, 11 stocks fell to a new 52-week low. This is the paradox of the hollow rally. It is the market's most deceptive illusion, a powerful sleight of hand, where the health of an entire system is judged by the performance of a few overinflated generals, while the soldiers in the field are in a state of catastrophic retreat. Most traders accept the index price as truth. This case study demonstrates that such trust is a fatal analytical error. The price of an index, like the S&P 500 or the Nasdaq, is a weighted average. It is not a democratic vote on market health. Instead, it is a plutocracy, where the largest companies have exponentially more influence than the smallest. A 10% gain in a $2 trillion company can single-handedly mask the 5% losses in hundreds of smaller constituents. The retail trader sees the headline number, the green arrow, next to the index, and assumes broad-based strength. The institutional analyst, however, looks beneath the surface. They dissect the market's internals, measuring its breadth. Market breadth is not concerned with how much the index has moved, but with how many of its components are moving with it. The most fundamental tool for this dissection is the advanced decline line, or the AD line. Its logic is brutally simple. Each day, it calculates the number of advancing stocks and subtracts the number of declining stocks. A positive number means more stocks went up than down, a sign of healthy participation. A negative number signals the opposite. In a healthy uptrend, the index price and the AD line should move in tandem, like a locomotive and its train cars, both climbing the same hill. They confirm each other. The danger signal, the first tremor before the earthquake, is divergence. This occurs when the index continues to make higher highs, but the AD line fails to do so, instead making a lower high. This divergence is a mathematical warning that the rally is narrowing. Fewer and fewer stocks are participating in the advance. The locomotive is accelerating, but it has left most of its train cars behind. The strength is an illusion, concentrated in a handful of megacap stocks that are dragging the weighted average higher while the broad market internally weakens. But the real power of this analysis is hidden in a parameter most traders ignore, a flaw in the AD line's own logic. The classic advanced decline line is a blunt instrument. It operates on a binary one-vote per stock system. It treats a behemoth technology firm surging $50 on groundbreaking news with the exact same weight as a small regional bank stock ticking up by a single cent. This is a significant logical vulnerability. To understand why this strategy fails 90% of the time for those who use it crudely, we must first examine the flaw in its core logic. To see the true internal hemorrhaging of the market, we must evolve beyond simple participation. We need to measure not just breadth, but force. This requires a more sophisticated weapon: volume-weighted breadth. Instead of merely counting advancers and decliners, this metric analyzes the total volume of shares traded in advancing stocks versus the total volume traded in declining stocks. It answers a more intelligent question: where is the money actually flowing? Where is the conviction? A market can have an equal number of stocks going up and down, resulting in a flat AD line. But if the declining stocks are trading on 4 times the volume of the advancers, it signals intense, institutional selling pressure. It reveals that the big money is quietly distributing shares and heading for the exits, even while the index price remains placid. This divergence between a rising price index and falling volume-weighted breadth is one of history's most reliable precursors to a market crash. It is the signature of distribution. It is the quiet, methodical offloading of risk by informed capital, masked by the headline-grabbing performance of a few market darlings. To isolate this pattern, we must place the 2000 financial crisis under the microscope. In late 1999 and early 2000, the Nasdaq Composite Index was a rocket ship, fueled by the dot-com mania. It surged past 4,000. Then 5,000. The public was euphoric. The new economy had supposedly rendered old metrics obsolete. The index was making vertical highs, but the internals were telling a story of catastrophic decay. While a handful of technology and telecom giants were responsible for nearly all of the index's gains, the broader market was already in a severe bear market. The classic AD line for the Nasdaq exchange peaked in the summer of 1998, a full year and a half before the index itself topped out. For 18 months, the index ascended while its foundations crumbled. But the volume-weighted breadth indicator provided the most surgical signal. It showed not just a lack of participation from smaller stocks, but an aggressive, high-volume exit. The selling volume in declining stocks consistently overwhelmed the buying volume in the few remaining leaders. It was a clear, unambiguous signal that the rally was hollow to its core. The index showed strength. The internals screamed collapse, but the final, definitive signal, the one that preceded the waterfall decline by exactly 47 trading days, was hidden in a piece of data almost no one was watching. It wasn't a stock chart. It wasn't a breadth indicator. It was the price of risk itself, priced not in equities, but in debt. We are talking about the high-yield corporate bond market. Junk bonds. Why would the fate of the world's most exciting technology stocks be written in the boring, forgotten world of corporate debt? Because junk bonds are the financial system's shadow market. They are the loans made to the riskiest, most speculative companies, the very same unprofitable dot-com dreamers that were fueling the Nasdaq's ascent. Think of it as a two-part bet. When you buy a speculative stock, you're betting on its potential for infinite upside. When you buy its junk bond, you are making a much more sober bet. Will this company survive long enough to pay me back? It's the ultimate test of solvency, not sentiment. For the entire euphoric rally of late 1999, stock investors were screaming, "Infinite growth!" But bond investors, the so-called smart money, had started quietly whispering a different word: default. This was the 47-day warning. The credit market slammed on the brakes, while the equity market was still flooring the accelerator. This divergence between credit and equity is the financial equivalent of seeing the ship's engineers screaming and running for the lifeboats while the passengers are still dancing in the ballroom. The message was unequivocal. The institutions that lend money for a living had suddenly stopped lending to the very companies the stock market was celebrating. The fuel line had been cut. The risk appetite of the entire financial system had evaporated. But the signal was hidden in an obscure corner of the market that retail investors, and even most professional equity traders, were completely ignoring. But this raises a terrifying question. If the market's internal breadth can be misleading, and even the smart money in the bond market can be ignored during a mania, is there an even deeper layer, a signal that bypasses market data entirely? To find that, we have to move from the charts on the screen into the minds of the market's most powerful players. We have to analyze a force that is not mathematical, but psychological. The insider's dilemma. Corporate insiders, the CEOs, CFOs, and board members, have a perfect, unadulterated view of their company's true health. They know exactly where the accounting tricks are. They know which customers aren't paying their bills. They see the demand that is evaporating long before it ever shows up in a quarterly report. And their actions, their buying and selling of their own company's stock, are public information. In a healthy market, insiders sell for many reasons: diversification, buying a house, taxes, but they typically only buy for one reason. They believe their stock is undervalued and is going higher. Therefore, the most potent signal is the ratio of insider selling to insider buying. And in the months leading up to the 2000 crash, that ratio became a siren, wailing at a frequency almost no one could hear. But what if the selling was a smokescreen for something far more sinister? What if the ultimate tell wasn't in the stock they sold, but in the bets they placed against it? This is the ultimate betrayal. It's one thing for an insider to quietly cash out their shares. It's another thing entirely to actively place a financial bet on the spectacular failure of the company you lead. This wasn't just selling a stock. It was shorting a dream. It was the captain of the Titanic, having seen the iceberg on the radar, secretly buying an insurance policy that would only pay out if the ship sank with everyone on board. These weren't just warning signs hidden in obscure corners of the market. This was a complete, systemic failure of trust, telegraphed by the very people at the controls. When the people with perfect information are no longer just cashing out, but are actively placing bets on catastrophe, the market is no longer a mechanism for price discovery. It has become a theater of deception. And like any grand illusion, it was destined to collapse the moment the audience looked behind the curtain. And so, the signals formed a perfect cascade of failure. The insiders, seeing the truth, began to sell and bet against their own firms. The smart money in the credit markets saw this distress and cut off the funding. The lack of funding starved the weaker companies, causing market breadth to collapse. And with the foundations rotted away by cynical insiders and starved of credit, the headline index had nothing left to stand on. It was a fall of 47 days, but it was a breakdown that was 18 months in the making. This isn't just a story about the year 2000. It's the timeless architecture of every market bubble and every catastrophic bust. The names of the stocks and the technologies will always change, but the sequence of events, rooted deep in human psychology and the flow of capital, remains the same. The narrative promises the moon, but the logic, hidden in the data, reveals the truth. The key is knowing where and how to look. The market is a sea of noise. Our job is to find the signal. It's not just about reading charts. It's about understanding the deep, interconnected logic between equity, credit, and the hidden motivations of the most powerful players. Don't just follow the price. Learn to decode the machine. If you're ready to move beyond the headlines and understand the forces that truly drive the markets, subscribe to Trade_Logic_Lab. Join us as we continue to dissect the patterns of the past to prepare for the opportunities of the future. Click subscribe and welcome to